Tesla basically hits 500,000 deliveries. Dan Ives makes a $3 trillion Tesla prediction, and one analyst finally seems to be understanding the potential of Tesla's energy business. Check this out.
Why do you love Tesla so much?
Look, I mean, to me, look, the main thing is, my view is on the autonomous and robotics side. I mean, I think this now, when it comes to, it's going to be one of the best AI plays over the next few years. That's why we think it's going to be a $3 trillion market cap. But if you look at the demand's turned around. I mean, this is a bounce back quarter that shows, yeah, still more work to do, but this is now setting up for what I believe is going to be a historical 2026, because the AI revolution now comes Tesla.
Well, it better, because the lead of the show with Dan Veru.
Yeah, that was great.
You're Dan Ives, by the way. He's Dan Veru. Was that every small cap stock in America combined is still smaller than NVIDIA. The same is basically true with cars. Every major car company in the world combined, can leave a couple out, are the same size or smaller than Tesla. Does that worry you at all?
Look, I mean, I was just in Detroit, and I think, you're definitely seeing some turnaround in GM and maybe, even in Ford. But the reality is that Tesla is not an auto company. I think Tesla is truly a disruptive technology AI play. When I think about, because the future is ultimately autonomous. I mean, when I think about autonomous and robo taxis and what's going to ultimately happen 30 to 35 cities in next year, that is $1 trillion alone from a valuation perspective in terms of a physical AI play. So that's why I think it's an apples to oranges what Tesla's doing in the rest of the auto sector. They're trying to play catch up.
Connect the dots, okay? I get the autonomous. I'm on the turnpike. I know where you live. You know where I live. I'm on the turnpike all the time. It's like demolition derby at this point. Cars are just going off in the woods. Everybody's on their phone. Half the people are stoned. I have no idea what's going on. I wish everybody had an autonomous car. Then we'd all just kind of cruise along the same way. We're a long way from that, Dan. A long way. How do we get there?
Well, first off, when you look at Tesla, I mean, today, let's call it 15% have full self-drive in terms of FSD. We think that's going to go to 50% over the next few years. So from a margin perspective, from a software perspective, that's going to be a game changer alone as that happens over the next few years. But in terms of autonomous, I mean, it's our view, 80% of autonomous world is going to be Tesla in terms of globally. So when you look over the next few years, you're talking about, let's say, 2 million vehicles. Eventually, you'll begin to 4, 5, 6, 7 million vehicles. I could argue when that doesn't even include robotics in terms of Optimus, that together could be more than the value of the company today. So that's our view. What's happening in this Tesla story is that the AI revolution, especially now with Musk back to being a wartime CEO, I mean, I think front and center, that's where we think $600 is probably conservative.
I've owned EVs. I've driven a lot of them. What they realized is weight is the enemy. Keep the car light and you can get more range, because if you do the way that we've been sold luxury now, cars are heavy, weight is the enemy of range. I think that's why Tesla is winning against many other companies. Does this also go to your very bullish view and possible M&A target of Lyft?
Mm-hmm. I mean, we put out our M&A target. I mean, I believe Lyft in the next 6 to 9 months is ultimately acquired as a top acquisition candidate, because it's the view of autonomous. Whether it's a strategic, whether it's a financial buyer, Lyft is one. If you combine that with an autonomous play, I think that's the future. I mean, that speaks to really this convergence that we're seeing in tech, autos, and you could say energy and some other sectors.
Where do they fit, though? You got Uber. Uber just seems to get all the attention.
Sure.
It also seems to get all the rides. I know it's not, being tongue-in-cheek. Rode in a Waymo, by the way, out in Los Angeles a couple times. That was pretty cool. It was a little weird at first, but then when you get used to it, you're like, oh, there's no driver. I don't know if that's it was good or bad. Where does Lyft fit in?
I think, look, the issue with Lyft is that obviously when it came to food delivery, mobility, and also being only a domestic player, but you look at what they have from a rideshare perspective in terms of that, in terms of that network, if you combine that with ultimately autonomous technology, that I think is how maybe on the strategic side, PE is going to look at names like Lyft. We just think this is going to be a tidal wave of M&A that happens in tech. Because with the AI revolution, still we think bottom of the second inning, you are going to continue to see this bull market play out. And that means strategic and financial buyers are going to be aggressive.
As usual, I think Dan Ives does get it. In my opinion, traffic deaths are creating an unstoppable regulatory pressure for autonomous vehicles. Dan Ives predicts Tesla will deploy robotaxis in 30 to 35 cities within a year and believes 80% of the autonomous worldwide market will be Tesla, with 2 million vehicles per year scaling to 4 to 7 million over the next few years. Dan emphasizes Tesla is an AI play and autonomous technology as the core of their $3 trillion valuation target. The most underappreciated driver of Tesla's autonomous future isn't the technology itself. It's the fact that over 40,000 Americans die in car accidents every year, with human error apparently causing 94% of all crashes. This creates enormous regulatory pressure to approve autonomous systems once they prove statistically safer than human drivers, even if they're not perfect. Regulators face an impossible political calculation. Every autopilot death makes headlines and creates outcry, but the 100 people who die in human-driven crashes that same day go unnoticed. Once Tesla demonstrates that their autonomous systems cause fewer deaths per mile than human drivers, even if it's 10% safer and not perfect, regulators will face massive pressure to approve it because blocking the technology means accepting preventable deaths. This safety focus is why Dan Ives' timeline matters so much. If Tesla achieves statistical safety superiority in the next 2 years, the regulatory approval becomes almost inevitable despite some members of the public fearing autonomous vehicles. And here's the crucial part. Tesla is the only company that can deploy this at massive scale quickly. Waymo's $200,000 vehicles have failed to scale beyond a few cities, despite being online for almost a decade now, while Tesla already has millions of vehicles on the road with the hardware needed for autonomy. Once regulatory approval comes, Tesla can activate autonomous features across their entire fleet almost overnight through software updates, creating the tidal wave Dan is describing. The combination of regulatory pressure from traffic deaths plus Tesla's unique ability to scale creates a scenario where autonomous adoption could happen far faster than most people expect. Not gradually over decades, but rapidly over 2 to 3 years as cities approve the technology and Tesla activates it across millions of vehicles simultaneously.
Bryn Talkington of Requisite Capital Management, also a CNBC contributor. When you're looking at the stock move today, is that something that you identify with, or can you understand why somebody might be in a position to sell and want to sell?
Sure. I mean, you always want to ask what's already priced in. And for weeks and weeks and weeks, Tesla shareholders feel we've all known that the EV credits in the U.S. were going to go away. So there was going to be a pull forward. How much of a pull forward, we didn't know. And so, yeah, they had record sales. So I think it's actually healthy that what was already priced in is now recognized. And so I think it's on to the next point. I do think in Tesla, it's really important what Phil talked about energy storage. So when I think about power storage and generation, last quarter, Elon talked about that segment had year-over-year gross profits of over 800 million. And if you think about this capacity, electricity constrained, environment we're in, once again, Tesla has this, I think, Trojan horse, this sleeping giant of power generation. They're just continuing to have very high margins on and continue to grow.
Do you think that outweighs the worries over margin pressure when it comes to the EVs?
Well, investors have been willing to look through and say, because if you look at Tesla on a fundamental basis, you would say over the last year and a half, sales are down, earnings have declined. To your point, margins have come down. And so how is the stock continuing to do, very well, approaching that, or it's over that December 2024 high? It's because investors are saying this is still a high growth company. Elon is back. He's locked in focus. And I think that when you see Robo taxis, when you see AI, when you see FSD, when these other verticals, which are not monetizing at this point, are out there on the horizon, investors are going to say, I'm never going to discount Elon, and I will give this company this super high valuation and look past the eroding fundamentals of the business that you have today, which is EVs.
Right now, the stock is at 443. You seem like you're pretty optimistic about the verticals that they have. You said the power generation. You've talked before about your interest in the robo-taxi business. Are you adding to your position at this level?
No, definitely not. I mean, I added at 290 when he announced the American Party and everyone, had a hissy fit on the stock. I did some more at 320. I love to sell calls on the name. It gives me the ability, I think, to have an outsized position. Today, some of those positions have been called away because I had sold calls. I wouldn't be adding here. If you look at the stock chart, it blew past 360, which was prior resistance. That actually also happens to be the 50-day moving average. I don't think it gets back to 360, but I do think at 440, and if you look at the chart, it's too vertical for me. So I'll let it settle back in here, wait for a headline to add to more positions.
All right, and talk to me a little bit about the robo-taxi, because we've seen the big hoopla over the launch of that. Do you still like what you see?
Love it. I mean, I'm based here in Texas, so a couple things. If you think about from a profitability perspective, I believe about 6 Waymos cost the same as 30 robo-taxis. So from a profitability, they're able to put so many more cars on the road. The geofence, which is where the robo-taxi is allowed to drive in Austin, continues to exponentially increase. And Elon had said on the last call that they are hoping to be unmanned, because they're still manned because it has to be safety first, unmanned in Austin and maybe San Francisco as well by the end of the year. That to me will be a next catalyst of this new vertical if they're able to get those robo-taxis fully unmanned and then start to compete against the Waymo. Because if you've ridden in one of those, they're a fraction of the cost of a Lyft or an Uber. And so I think this is going to be where people are going to start paying attention to this new vertical as the years progress.
Tesla's energy storage business is a sleeping giant that analysts finally recognize. Bryn Talkington highlights that Tesla's power storage and generation segment had year-over-year profit growth of over $800 million last quarter, calling it a Trojan horse and sleeping giant with very high margins that continue to grow. She emphasizes this becomes crucial in an electricity-constrained, capacity-limited environment. The energy storage opportunity represents one of the most undervalued aspects of Tesla's business model, and Bryn is one of the first mainstream analysts to properly quantify its potential. While everyone focuses on EVs and robotaxis, Tesla has quietly built a massive energy storage business that generates over $800 million in quarterly profits, with margins that exceed their automotive business. This matters enormously because the AI revolution and electrification are created unprecedented electricity demand that existing infrastructure can't support. Data centers powering AI models, EV charging networks, and renewable energy integration all require massive battery storage solutions to manage grid stability and peak demand. Tesla's energy storage products, from home power walls to utility scale megapacks, address this exact bottleneck. The business compounds in value as electricity constraints worsen because customers become more desperate for storage solutions and price sensitivity decreases when the alternative is blackouts or inability to power critical infrastructure and data centers. What makes this particularly powerful is that Tesla leverages the same battery manufacturing expertise and supply chains they've built for vehicles, giving them cost advantages competitors can't match. While standalone energy storage companies struggle with unit economics, Tesla achieves high margins because they've already solved battery production at massive scale. This hidden business could eventually rival the automotive division in profitability and scale, while requiring far less capital investment and operating with higher margins. Don't sleep on Tesla's energy.